Mexico just announced export restrictions on silver to the United States. Nobody's covering this. Mainstream financial media silent. Silver ticked up 2%, then pulled back. Markets acted like nothing happened, except Mexico supplies 23% of total U.S. silver imports. That's 1,047 metric tons annually. And the announcement came 72 hours before COMEX March contract first notice day. John AG analysis here. If your first reaction is, that sounds exaggerated or I haven't heard about this, good. That's the critical thinking this channel is built on. Don't trust headlines. Don't trust me. Trust primary source documents. This analysis pulls from Mexican Economy Ministry public announcements, U.S. Geological Survey trade data, COMEX delivery reports, and Shanghai Futures Exchange settlement prices. Everything I show you today is verifiable. The sources are time-stamped, dated, public record. The ones who actually verify this data, they understand why a Mexican export restriction isn't just another news story. They see the supply chain implications, they recognize the timing signal, and they stay. Before we go further, if you're watching this channel for the first time, subscribe to the backup channel now, John AG Analysis Backup. One video is already up. That's how you verify it's legitimate. Why does this matter? Financial content covering precious metals, manipulation, supply disruption, and monetary policy gets flagged. Algorithmic suppression is real, documented, measurable through view to subscriber ratios. I'm not asking for trust. I'm telling you to prepare for content disruption. When analysis contradicts establishment narratives on dollar stability and metals markets, platforms respond. The backup exists, so continuous research reaches you regardless of primary channel status. Link in description. Go subscribe now, then come back. This information doesn't wait. Current prices as I'm recording. Silver Western Spot 77.40. COMEX Futures March Contract 77.15. Shanghai Spot Y 7,180 per kilogram. That converts to 85.70 per troy ounce at current exchange rates. Shanghai Premium 8.30, not $2 or $3, $8.30. Physical silver in Eastern markets trading nearly 11% above Western paper pricing. Now watch this spread carefully. Last week, Shanghai Premium was 6.15. Week before that, 4.80. We're seeing systematic premium expansion while Western prices consolidate. Mexico's announcement came February 11th, 2025 through their Economy Ministry Secretariat, official document SE 012-2025. Export restrictions on strategic minerals including silver, effective immediately, with export permits required for all commercial shipments exceeding 100 kilograms to non-USMCA partners. Here's what they're not saying clearly. The permit process has no defined timeline, no approval criteria, no exemptions listed for existing contracts. That's a soft ban with bureaucratic cover. U.S. Geological Survey data 2024. Total U.S. silver imports 8,043 metric tons. Mexico supplied 1,847 metric tons, that's 23%. Peru second at 1,610 metric tons, 20%. Canada third at 1,124 metric tons, 14%. If Mexican supply drops even 50% due to permit delays, that's 923 metric tons annually. 29.7 million ounces, divided across 12 months, 2.475 million ounces monthly. COMEX registered silver inventory right now sits at 38.6 million ounces total. Do the math. 2 months of lost Mexican imports equals 5.4 million ounces. That's 14% of entire COMEX registered inventory. Check USGS Mineral Commodity Summaries 2024. Check Mexican Economy Ministry document SE 012-2025. It's published, it's dated, it's verifiable. Here's what really happened, and why the timing matters more than the announcement itself. February 27th is first notice day for COMEX March silver futures. That's 16 days from Mexican announcement. March contract currently shows 68,366 contracts open interest. That's 341.83 million ounces of paper claims against 38.6 million ounces registered physical inventory. Standard fractional reserve metals market, 8.85 paper claims per ounce of deliverable silver. Normal operations, most contracts cash settle. Traders take profit, roll to next month, or accept cash equivalent. System functions because physical delivery remains exception, not rule. But February contract just broke that pattern. February deliveries hit 23.4 million ounces. That's 105% of total open interest that existed at January contract start. Over 100% delivery rate means new contracts opened specifically for physical delivery during month. When delivery demand exceeds initial open interest, that's not normal trading activity. That's physical acquisition, using futures market as procurement tool. Now Mexican supply disruption hits news cycle. Soft ban through permit requirements with no timeline creates immediate uncertainty for U.S. refiners, manufacturers, and industrial users. Solar panel production, electrical components, medical equipment, photography, and electronics all depend on consistent silver supply. Industrial users can't wait for permit approvals with undefined timelines. They need supply continuity. Where do they turn? Futures markets, physical delivery, immediate procurement. Here's the mechanism. Large industrial consumer hedges silver needs through futures contracts. Normally they cash settle, buy physical through normal supply chains. But if Mexican supply uncertain, normal channels disrupted, they stand for delivery instead. Every industrial consumer who shifts from cash settlement to physical delivery adds pressure to COMEX registered inventory. System designed for 10 to 15% delivery rates, not 50-60%. Mexico announcement 72 hours before potential industrial response creates maximum pressure at minimum reaction time. Check COMEX delivery data daily updates. February final delivery count published. March open interest updates real time. Mexican Economy Ministry document public record. This isn't conspiracy. This is supply chain disruption meeting fractional reserve market structure with documented delivery pressure already building. Let's connect the technical structure because this is where multiple data points align. Silver 4-hour chart. Price consolidating between 76.20 support and $79.50 resistance for past 6 days. That's a tightening range. Lower highs, higher lows. Compression pattern. 50-period exponential moving average on the 4-hour currently at $77.10. Price trading above, that's structural support holding. 200-period EMA at 74.85. Price well above, uptrend structure intact. But here's the volatility signal. Bollinger Bands on the daily chart contracted to narrowest width in 14 days. Band width measures volatility. Narrow bands precede expansion moves. Direction unclear, but magnitude significant when breakout occurs. Mexican export restriction adds fundamental catalyst to technical compression. That's confluence. Now layer COMEX inventory data. Registered silver 38.6 million ounces. Eligible silver 202.4 million ounces. Total 241 million ounces. Eligible cannot be delivered against futures contracts without owner consent and reclassification to registered. Registered is what matters for delivery. 38.6 million ounces against 341.83 million ounces March open interest. January 15th, registered inventory was 43.2 million ounces. February 15th, 38.6 million ounces. That's 4.6 million ounces drawn down in 30 days. 10.6% decline 1 month. If March delivery rates follow February pattern and Mexican supply disruption pushes industrial users toward delivery, registered inventory could drop below 30 million ounces by March expiry. That would be 30% drawdown in 60 days. When registered inventory declines that fast, COMEX has 3 options. 1. Encourage eligible holders to reclassify. 2. Allow cash settlement over physical delivery even when delivery requested. 3. Adjust margin requirements and contract specifications to discourage delivery. All 3 are price suppression mechanisms. But all 3 have limits. Eligible silver owners don't reclassify without premium compensation. They know tight inventory means negotiating power. Cash settlement over requested delivery triggers legal challenges and exchange credibility damage. Margin requirement changes get noticed, create headlines, accelerate the very bank run they're trying to prevent. Now add Shanghai Premium, $8.30 and expanding. When Eastern physical markets consistently pay premiums above Western paper pricing, that's arbitrage signal. Buy COMEX futures, stand for delivery, ship to Shanghai, sell at premium. If premium exceeds shipping, insurance, and financing costs, arbitrage profit exists. Current Shanghai premium $8.30. Shipping and insurance costs for silver shipment US to China approximately 1.20 per ounce for commercial quantities. Financing costs at 4.5% annual rate for 30-day settlement approximately 0.30 per ounce at current prices. Total arbitrage cost $1.50, premium $8.30, net arbitrage profit 6.80 per ounce. That's not minor arbitrage. That's massive dislocation between physical and paper markets. When arbitrage profit that large persists for weeks, it signals either physical unavailability in Eastern markets or delivery constraints in Western markets, likely both. Now add supply chain geopolitics. Mexico's export restriction follows pattern across Latin America. Peru reviewing mining export regulations. Chile increased copper export taxes last quarter. Bolivia nationalized lithium production. Ecuador renegotiating mining contracts. Resource nationalism accelerating across commodity-producing nations. When multiple countries simultaneously restrict exports or increase state control over strategic minerals, that's coordinated policy response to something. What's driving coordination? dollar weaponization through sanctions, frozen Russian reserves, confiscated Afghan central bank funds, Venezuela, Iran, Syria, all locked out of dollar system. Commodity-producing nations watching monetary system weaponized against geopolitical rivals recognize vulnerability. If reserves can be frozen, confiscated, sanctioned, then holding dollars is risk, not safety. Response mechanism. Retain physical resources, reduce dollar exposure, demand alternative settlement currencies, build regional trade frameworks. Mexico's silver export restriction isn't isolated policy. It's part of hemispheric realignment away from dollar-denominated commodity flows. When silver producer nations restrict exports while Eastern markets pay record premiums and COMEX inventory declines, that's supply chain fracture in real time. Check COMEX registered inventory data, updated daily. Check Shanghai Futures Exchange settlement prices. Public data, calculate arbitrage yourself. Verify shipping costs through freight rate indices. Check Mexican Economy Ministry announcements. Read Peruvian Mining Ministry policy reviews. Each data point individually explainable. Together they show pattern. Here's what's different this time, and why the next 72 hours matter. First notice day, March contract, February 27th. That's when traders must declare intention for physical delivery or cash settlement. Historically, delivery intentions submitted final 3 days before first notice day. That puts critical decision window February 24th through February 26th. 3 days where industrial users, bullion banks, and large speculators commit to delivery or exit positions. Mexican announcement February 11th creates exactly 16 days for industrial silver consumers to assess supply chain risk before delivery decision deadline. Large industrial consumer, let's say solar panel manufacturer, uses 200,000 ounces monthly. Normally sources through Mexican refinery partnerships and spot market purchases. Mexican export permit requirements with undefined timeline puts 200,000 ounces monthly supply at risk. Risk management response. Secure alternative supply immediately. Futures market delivery most direct mechanism. 2,000 contracts, stand for delivery, take physical settlement, backstop supply chain. Now multiply across industrial sectors. Electronics, medical devices, automotive, photography, electrical components. Total U.S. industrial silver consumption 184 million ounces annually, according to Silver Institute 2024 data. That's 15.3 million ounces monthly. If even 10% of monthly industrial consumption shifts to futures delivery for supply chain security, that's 1.53 million ounces additional delivery pressure. 1 month. March registered inventory 38.6 million ounces. Subtract typical monthly deliveries 8-10 million ounces. Subtract additional industrial delivery 1.5 million ounces. Registered inventory drops to approximately 28 million ounces by March expiry. That's 27% drawdown. April open interest builds against depleted registered stock. Cycle accelerates. But here's the timing signal most people are missing. Shanghai Futures Exchange data shows backwardation expanding. Front-month contract premium over deferred contracts widened to wide to a 340 per kilogram. That's $4.05 per ounce. Backwardation means immediate delivery worth more than future delivery. Normal commodity markets show contango, future prices higher than spot because storage and financing costs. Backwardation signals shortage. When backwardation expands same week, Mexican export restriction announced, Eastern markets are pricing immediate supply deficit. Western paper markets haven't caught up yet. Silver consolidating $76 to $79 range. Bollinger Band compression. Low volatility. Calm before expansion move. Fundamental catalyst, Mexican supply disruption. Technical setup, compression pattern, volatility contraction. Structural pressure, COMEX delivery rates elevated, inventory declining. Geopolitical context, resource nationalism, Shanghai premium expansion backwardation. Timing trigger, 72-hour window before industrial delivery decisions due. That's confluence across 4 separate data categories pointing same direction, same time frame. Connect Mexican export restriction to broader monetary policy because these events don't happen in isolation. Federal Reserve balance sheet currently $6.8 trillion. Down from $9 trillion peak 2022, but still 75% above pre-COVID levels. Quantitative tightening officially continuing, but pace slowed dramatically. January 2025 Fed balance sheet declined $12 billion. December declined $8 billion. November declined $15 billion. That's quantitative tightening at slowest pace since tightening cycle began. Why does QT pace matter for silver? Because when Fed balance sheet expands, dollar liquidity increases, commodity prices rise. When balance sheet contracts, liquidity tightens, commodity prices theoretically fall. Except silver up 150% past year despite QT, gold up 76% during same period, copper up 34%, Commodities breaking out while Fed shrinks balance sheet? That's not supposed to happen. Unless physical supply constraints overpower monetary policy impacts, unless dollar debasement via fiscal spending overwhelms monetary tightening, unless international dollar rejection accelerates. Mexican silver export restrictions reduce dollar-denominated commodity flows. Every ounce of silver Mexico restricts from U.S. export is one less ounce backing dollar commodity trade, one less ounce flowing through dollar settlement system. When commodity producers restrict exports, commodity consumers need more dollars to bid for less supply. Dollar demand increases, but dollar credibility decreases because commodity backing shrinks. This is the paradox. Short-term export restrictions increase dollar demand. Long-term, they expose dollar dependency on commodity access rather than intrinsic value. Now add corporate debt situation. U.S. corporate debt $10.5 trillion, investment grade $7.2 trillion, high yield $1.8 trillion, private credit $1.5 trillion, interest coverage ratio, the measure of earnings to interest payments, dropped to 4.2x for investment grade corporates. That's lowest since 2020. High yield coverage ratio 2.1x, any earnings decline, any rate increase, coverage breaks. 9 large corporate bankruptcies last week. 3-week average 6.4 bankruptcies per week. That's elevated, but not crisis, yet. But combine rising corporate stress with supply chain disruptions, that's stagflation setup. Costs increase from supply restrictions. Revenues decline from economic weakness. Margins compress. Defaults accelerate. Silver industrial demand drops if manufacturers go bankrupt. But investment demand increases if dollar confidence declines and inflation accelerates. Net effect depends on which force dominates. 2008 financial crisis. Silver dropped from $20 to $9 because industrial demand collapsed faster than investment demand increased. But 2020-2021, silver climbed from $12 to $30 because monetary expansion overwhelmed industrial disruption. Current setup looks more like 2020-2021. Massive fiscal spending, $1.8 trillion deficit projected 2025. Fed balance sheet still 75% above pre-COVID, corporate debt at record highs, supply chain disruptions from geopolitical fragmentation. Mexican export restriction, one more supply constraint, an increasingly constrained commodity complex, while monetary conditions remain loose despite QT. The bearish case matters. Let's be honest about what could go wrong. Mexican export restriction could be negotiating tactic, not permanent policy. USMCA partners may receive exemptions. Permit process might approve applications quickly. Disruption could be minimal. U.S. has alternative silver sources. Peru, Canada, Chile all produce significant silver. Refiners can shift supply chains. Industrial users maintain inventory buffers for exactly these disruptions. COMEX registered inventory 38.6 million ounces. That's still substantial. Even at elevated delivery rates, that's multiple months of supply. Eligible inventory can reclassify if premiums justify. Shanghai premium expanded before and contracted. $8.30 premium could close rapidly if Chinese demand softens or if Western supply increases. Arbitrage opportunity exists until it doesn't. Technical compression pattern could break downward, not upward. Bollinger Band expansion doesn't predict direction, only magnitude. If macro conditions deteriorate, risk assets, including silver, could sell off regardless of supply fundamentals.